studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
In the previous sections, we explored option 1, where investment income is reported using a combination of actual information and reasonable estimates. While that approach often provides better matching between income and the corporation's fiscal year, it comes with a cost. Every year requires estimates. Every year requires reconciliations. And every year the estimation cycle continues. This brings us to option 2. Option 2 takes a very different approach. Instead of estimating missing investment income, the accountant simply uses the T-slips as they are received. The philosophy is straightforward. When a T3 arrives, record the T3. When a T5 arrives, record the T5. Use the amounts reported on the slips and include them in the corporation's reporting for that year. No estimates, no allocation calculations, and no ongoing cycle of removing old estimates and creating new ones. This is why many practitioners view option 2 as the simpler alternative. The process becomes much more direct. First, the corporation receives its T-slips from banks, brokerage firms, mutual funds, and other investment institutions. These slips contain the official tax information that has also been reported to CRA. Next, the accountant records the amounts shown on those slips in the accounting records and tax working papers. Because the amounts come directly from official tax documents, there is generally less need for estimation and supporting calculations. The information can then be reconciled, reviewed for completeness, and incorporated into the corporation's tax return. The result is a reporting process that is often easier to manage and easier to maintain from year to year. One of the major attractions of option 2 is administrative simplicity. There are fewer working papers, fewer estimation schedules, and fewer year-to-year adjustments. The accountant is largely relying on the same information that CRA receives from the investment institutions. However, it is important to understand that option 2 is making a trade-off. By avoiding estimates, the corporation accepts that some investment income may not perfectly match its fiscal year. In other words, simplicity is gained at the expense of perfect timing accuracy. That trade-off is at the heart of this methodology. The key takeaway from this slide is simple. Option 2 says, use the T-slips as they arrive, record the amounts reported, and avoid the ongoing estimation process. It is a practical approach that prioritizes simplicity, efficiency, and ease of administration over perfect fiscal year matching. One of the most common objections to option 2 is this: if we're not estimating the missing months of investment income, aren't we leaving income out of the tax return? At first glance, that seems like a valid concern. Let's see why the answer is actually no. The key concept is that income may be delayed, but it is not lost. Consider a corporation with a February 28th year end. The corporation's taxation year runs from March 1st of one year to February 28th of the next year. Now remember how T3 slips work. They are issued on a calendar year basis and report income from January 1st to December 31st. Under option 2, the accountant simply records the T3 as received. No estimates are created for the January and February period that falls after December 31st. When students first see this, they often become concerned. They notice that January and February income for the current fiscal year does not appear on the T3 that is being used. And naturally they ask, did we forget that income? The answer is no. That income simply appears later. Let's follow the timeline. Suppose January and February 2021 income is not included in the current reporting year, because the T3 only covers up to December 31st, 2020. What happens to those 2 months? They don't disappear. When the next T3 is issued, covering January 1st, 2021 through December 31st, 2021, those same January and February amounts are included on that future T3. And when that future T3 is recorded, the income is ultimately reported. In other words, the income moves forward in time. It is shifted from one taxation year to another, but it is not omitted permanently. This is the most important concept in Option 2. The methodology accepts timing differences. It does not ignore income. It does not eliminate income. And it does not create a permanent reporting gap. Think of it like a moving conveyor belt. Each year's T3 carries a different 12-month period of investment income. As long as the corporation consistently records the T-slips each year, all of the income eventually flows through the reporting system. Nothing falls off the conveyor belt. Nothing disappears. Some amounts may simply arrive in a different taxation year than they would under Option 1. And that is exactly the trade-off being made. Option 1 focuses on matching income to the correct fiscal year. Option 2 focuses on simplicity and accepts that some income will flow into the next reporting period. The key takeaway from this slide is simple. Under Option 2, income is not lost. It is simply reported when it appears on the future T-slip. The timing changes, but the income ultimately gets reported. Now that we've explored both Option 1 and Option 2, an important question remains. Which approach is actually better? The answer may surprise you. There is no universally correct answer. The best approach depends on the circumstances of the corporation and the priorities of the people preparing the tax reporting. Let's begin with Option 1. Option 1 focuses on matching investment income to the corporation's fiscal year as accurately as possible. The methodology uses estimates when necessary, adjusts those estimates when actual information becomes available, and attempts to ensure that income is reported in the period to which it economically belongs. Because of this, Option 1 often provides better fiscal year matching and more precise timing accuracy. From a technical perspective, many accountants view it as the stronger reporting approach. However, that accuracy comes at a cost. The corporation must maintain estimates. The estimates must be documented. Actual results must be reconciled to prior estimates. And the process repeats year after year. As we've seen, the estimation cycle never truly ends. Now let's look at Option 2. Option 2 takes a very different philosophy. Rather than estimating missing income, the accountant simply records the T-slips as they arrive. The process is straightforward. Receive the T3. Receive the T5. Record the information. Prepare the return. Because estimates are avoided, the bookkeeping process is generally simpler. There are fewer calculations, fewer reconciliation schedules, and less ongoing administrative work. For many corporations, that simplicity is very attractive. Of course, Option 2 also involves a trade-off. Because income is reported when it appears on the T-slips, timing differences remain. Some investment income may be reported in a different taxation year than it would be under Option 1. As a result, fiscal year matching is not as precise. This brings us to the balancing scale shown in the center of the slide. On one side is accuracy. On the other side is simplicity. Option 1 leans toward accuracy. Option 2 leans toward simplicity. Neither side is inherently right or wrong. The choice depends on what matters most in a particular situation. For example, a corporation with a large and complex investment portfolio may prefer Option 1 because accurate fiscal year matching is more important. On the other hand, a corporation with relatively straightforward investment activities may decide that the simplicity of Option 2 outweighs the benefits of more precise matching. And that leads us to perhaps the most important lesson in this entire chapter. Neither method is perfect. Both methods can be reasonable. What matters most is consistency. Once a methodology has been chosen, it should be applied consistently from year to year and supported by appropriate documentation. The ultimate goal is not perfection. The goal is to report all investment income using a reasonable, supportable, and defensible methodology. The key takeaway from this slide is simple. Option 1 provides better matching. Option 2 provides greater simplicity. And the best method is the one that is appropriate for the corporation's circumstances and applied consistently over time.